ESG funds are the latest buzzwords in the world of investing today. What are ESG funds? How different are they from traditional equity funds? Should you invest in those funds? If yes, how much should you allocate to those funds? These are the questions on top of investors' minds today. I, Chirag Mehta, Senior Fund Manager, Alternative Investments at Quantum Mutual Fund, will tell you all you want to know about ESG funds. What is ESG? ESG stands for environmental, S stands for social, and G stands for governance. So what are ESG funds? ESG funds invest in companies that are environmentally conscious, socially responsible, and follow good corporate governance standards. These funds consider the impact of companies' business activities on the environment and the society and measures how well governed, ethical these companies are to take a holistic view on the true sustainability of companies. Investing in good, sustainable companies is a time tested way of wealth creation over the long term. These are quality businesses that survive and thrive over the long run, making great wealth for the investors. What are ESG factors? What kind of factors do these funds look at under ESG and how do they measure them? Under each of the pillars of environmental, social, and governance, they look at a whole host of factors, and these would include how corporations respond to climate change, what are the pollution levels, how good they are with energy, water, waste management. On the social side, they would measure how they treat their workers and other stakeholders, how effective their health and safety policies, how they manage their supply chains. In totality, across ESG, these funds would measure somewhere between 200 and 250 factors, metrics to evaluate the companies on a holistic basis. Good ESG companies tend to be more efficient and innovative with their operations or their business activities. If you look at ESG factors, they do not look at the financial side of it. These are normally non-financial factors, but they tend to have a material impact on the firm's valuation. Either they will impact the revenue, profitability, or be it market perception of that company that eventually translates or reflects in the share price of that company. There are many examples of poor corporate governance responsible for financial collapse of prominent companies across a whole host of industries, be it ranging from airlines, banking, software, FMCG, etc. ESG analysis, at the end of the day, helps to avoid weak companies and choose those which are better prepared to deal with today's complex challenges, hence maximizing shareholder wealth in the long term. When businesses fail to consider the long-term impact of their actions on investors, communities, or be it the ecosystems, and focus only on short-term profits, they tend to increase the risk of severe incidents, regulatory actions, or litigations for the company. This will lead to major expenses for the company and also eventually translate into lower profitability and a poor valuation of that company. What are the characteristics of good ESG companies? How good these companies are? They kind of engage proactively with all stakeholders. There is no evidence of harmful relationship, the third-party transactions or any other business activities. It's clean for these companies. They have a very strong risk management. They're ahead of the curve and ready for disruptive changes. As I said, they are innovative and efficient. They have a good board and management that drives the organization forward. If you look at today, institutional investors globally are moving ahead towards ESG investing in a big way. It's not only because they kind of mitigate the risk of being with bad companies, but there are opportunities with the emerging environmental and social trends that these investors want to capture and reap benefits over the long term. There are opportunities, significant opportunities with good ESG companies. For example, climate change is a real threat, right, to economies, to businesses, and therefore companies that tackle climate change in an appropriate manner is the one that will survive and thrive over the long term. Businesses with strong ESG profiles enjoy lower cost of capital, usually have improved operational performance, have lower tail risk associated, and therefore Street does kind of honor that and give a higher valuation to these kind of companies. All these investors are not only moving towards ESG in a big way just because citing the opportunities at risk, but there is enough evidence now of ESG doing well. ESG has been, or investing in sustainable companies has been a concept which has been there for a very long term, but it kind of really had an inflection point or really picked up since 2006. And since that time, over the last 15 years, there's enough evidence that has been piling up in terms of companies doing well, ESG indices doing well, that the normal stock market, market cap weighted indices, for example, the MSCI India ESG index has done better than the MSCI normal market cap weighted index, or Nifty 100 ESG index has done better than the Nifty or the Nifty 100 index. And over the last 2-3 years, there have been many ESG funds being launched, and many of these funds have done better as compared to even these ESG indices who have done better than the normal stock market indexes. So there is enough evidence at the company level, at the index level, at the fund level that tells you that ESG does work well. And therefore, this move is only getting bigger day by day. But when investors are investing in ESG funds, they need to keep in mind that the real benefits of ESG investing will only be received in the long run. Over a market cycle, at least, that is where these companies will shine and appear better than normal companies. With ESG investing, the idea is to overweight sustainability along with a good diversification, looking at financial metrics from a financial sustainability perspective, and therefore these companies kind of deliver superior long-term risk-adjusted returns. That is our idea of how we perceive ESG as. But overall, with ESG, we will end up having more valuable companies, more value for end investors, and ultimately a more sustainable system. ESG investing allows you to invest with your values in businesses that are clean, responsible, fair, transparent, ethical, and have a positive societal impact. And yet, these companies would probably deliver sustainable profitability in the long run. ESG investing aims to achieve the triple bottom line that we all were looking for. Investing that is good for planet, good for people, and good for your profits. So I will say this is an opportunity to vote with your wallet, invest in companies where your belief and value systems lie. So invest in ESG funds today. How much to invest? We would probably say if you're putting 100 rupees in equities, of that 100 rupees in equities, you should probably have 15 to 20 rupees in ESG funds. And as evidence gathers further that ESG does work well, look, at the end of the day, we are trying to find sustainable companies, and ESG is a process to get to those sustainable companies. And as evidence gathers in ESG as a process to really work well and identify those sustainable companies, that is where you can start increasing your allocation. So start with 15 to 20% of your equity bucket as ESG funds, and then you can increase it over a period of time as you are convinced more with the performance that ESG delivers. So with that, I hope I have answered all your queries on ESG funds or given you a good insight on what these ESG funds are. If you have any questions, do reach out to us at Quantum Mutual Fund, and we'll be more than happy to answer your queries. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.